Mike Amy, as we introduced him earlier, is from Pimco, Europe, and joins us. Your reaction, first of all?
I think the key aspect of a stronger number is it probably reduces the chances of around a QE in May. I think a big weak number would have made QE really quite likely. The bank has a habit of responding to the quarterly GDP.
Is that why gilts are reacting in the way they are?
That's right, yeah. So there's two things going on with gilts. The first is that I think the Bank of Japan has affected all of the major government bond markets, and that's depressing yields. But the expectations for QE in the UK, they vary a little bit, but I think our expectations there will be more. It's a question of when. This probably pushes that back a little bit, frankly.
What does it mean for austerity? There's this big debate. The UK is really being slapped by the IMF, but also the European Commission for pushing austerity too much. Is this almost a vindication, saying, well, look, we're still kind of growing?
So politically, obviously, it's very good news if you're George Osborne. I think from where we sit, we look at the broader picture and say, well, growth this year we expect to be around about 0 to 1% for the calendar year. Last year was 0.2. Activity is still down 3% in real terms from the peak in 2008. It's pretty clear to us the aggregate level of stimulus is not enough to get any kind of momentum going in the economy. We think they should look to something else. FLS, I think, frankly, is a bit of a damp squib, to be perfectly honest with you, from yesterday. So we think they have to do more. It's a question of what they can do.
This number's likely to be revised higher. Would that be the expectation? What do you think will ultimately end up be looking like here? Because if you're transferring along at sort of 0.5%, in comparison with the rest of Europe, that starts to look positively great.
Well, relative to the rest of Europe, it looks great, but relative to growing, labour employment and growing the take-home pay, it's not really cutting the mustard, frankly. So I think 0.5%, 1%, you're running below trend. I think whatever you think trend is, I think trend rate of growth is 0 to 1, then we have some really very significant problems.
Mike, what does it mean? We're just listening to Manus kind of going through some of the banks and what they're playing. How would you play gilts at the moment after that better than expected GDP figure? Okay,
I think there's a couple of things you can do. The first is that as Manus pointed out, gilts trade flat to treasuries. At 1.7% on either of them, for a big rally from here, you would need something very ugly to happen either in Europe or woe forbid, China to go through an accelerated slowdown. So I think if you want a genuinely risk-free asset, then US Treasuries look like the most appealing at this point in time. I think if you're looking domestically, then we still stick by the core thesis that the Bank of England is willing to tolerate higher than expected inflation. They have done for a number of years. Interest rates across the curve are either at or below inflation. So if that's the case, you've got to think about how you can protect the real value of your savings. We think that the better way to do that, rather than nominal bonds, is to own inflation-linked bonds. Now, real yields are negative, but obviously there's a difference between the RPI and the CPI. And if you've got to buy nominal gilts, then try and identify 5 to 10 year bonds where rates are unlikely to rise. In the 30-year sector, 3% interest rate. At some point, it's going to go up. Probably not anytime soon, but it's not a good medium-term value at 3.
The criticism of the UK and its policy mix is growing. Do you think, to say the least, do you think that the Chancellor, do you think a good number actually gives the Chancellor more wiggle room?
Absolutely, yeah. I mean, a good number definitely gives him more wiggle room. I think the key debate from where we sit is that, the government is, the economy is broadly speaking flatlining, I think, frankly. And you've got to ask yourself, well, what levers can the authorities pull to stimulate the economy? Now, the private sector and the banking system is constrained by either excess debt in the case of the private sector or not enough capital in the case of the banking sector. So somebody has to provide some cash to the system. Now, if the banking system is undercapitalized and it's not going to lend to the riskiest parts of the economy, which are typically the ones that are going to grow productivity and improve employment prospects. So if they're not going to do it, then either somebody has to step in and provide the capital via a guarantee, which is one of the ways you could have used the funding for lending scheme, but has not been used that way. And if you can't do that, then you've got to think about government infrastructure projects, which I think is something that we've been saying for a while, but doesn't seem to have got a lot of traction. There's a few government-sponsored schemes going on, but none of them seem to have any traction.
And corporate surpluses? How do you get those moving? This is a confidence game.
It is, yeah. So as you know, corporate cash piles are pretty close to record highs. But the corporate sector doesn't have any clarity on where growth is going to come from. So if the corporate sector looks at the largest element of demand, which is typically the consumer, and says, well, the consumer has got, 1% nominal income growth and, let's call it 3% inflation, that's minus 2% real. So you're not going to get a lot out of the consumer sector. You've got to think about where the demand is going to come from. It will eventually come from exports, but our exports need to reorientate. So in the short term, you've got to think about whether there are, demands from other parts of the economy, which would be the business investment or state-sponsored investment.
It's tough out there, isn't it? The main problem is that what companies such as yourselves are a little bit scared about asking for lending. What's holding you back?
I think you need to have a confidence in your own company. And from 2008 maybe till more recently, the banks have been quite reluctant to take risks on small companies. And so you really do have to make sure that your company is robust and have a great plan.
When you have a conversation with a bank, how does it go? What are they saying? I'm really interested in the kind of actually how the relationship works.
Well, I've had a strange relationship personally with my bank because I actually haven't had that much of a relationship with them because we didn't need funding.
Right.
So the last sort of 12 months for me has been about building a great relationship with the manager, letting him know about our business, so that at the point when we really want to go for expansion and want to get some funding, that he already knows what we're about and understands the risks associated with us.
Mike, does the government need to do more for small and medium enterprises? Because if you inject more lending, if you give them that confidence to grow, then GDP can really pick up.
Oh, I absolutely agree with you. I think if you look at the policies that are going on at the moment, the key area of weakness is the SME sector. The household sector has plenty of access to cash via, the banks. The large cap corporates, you can see it in the data, have been shifting between borrowing from the banks and borrowing from the bond market, and it's the SME sector that sits in the middle. And I think if you think about how the economy is going to grow from here, then everybody's got to be in this together, and everybody needs access to funds. So I think that's exactly where the government should be focusing. Yeah.
You're not impressed with funding for lending, though?
No, I don't think the challenge with funding for lending is that it doesn't provide capital to the system. So if I'm a bank, banks can get as much liquidity as they like. Liquidity isn't the problem. No. The problem is capital. And of course you have on the one hand the provision of liquidity. On the other hand you have the same entity, which is the Bank of England. Indeed, Mervyn King in his letter to George Osborne yesterday, stating that this is not an alternative to raising capital, and the banks need to raise capital. So it's quite tough if you're a commercial banker to on the one hand be told to raise capital, and then on the other hand to lend to ultimately the riskiest parts of the economy, which is the SME sector. And
FleetSolve is actually bucking the trend. You're growing, you're employing more people. What is the one thing that you're most worried about, and what can the government do to make it easier for you?
I think, if the economy can improve overall, that will have a knock-on effect. We are seeing energy prices rise. That isn't necessarily bad for FleetSolve because we're a renewable energy company, so that's not so bad. But, your suppliers, the banks, even your clients will take longer to make decisions in a poor economy. So if we can get that economy strengthened. But also, I think they need to do a legacy of some really good training programmes, listen to what employers actually need, get apprentices back on, get some vocational skills in there.
Structural reform.
Yeah.
We're spending a lot of time in this country talking about how monetary policy can fix everything, that more bank lending is going to solve the problem. That's not what you're saying. You're saying what we need is structural reform. We need to change the education process. We need to change employment law. We need to change how the very fabric of the economy works.
I think so, and I think there's a lot of skills and talents that are there now, but we need to make sure that they're still coming through for the next generations, and that as an employer I do want to see that there is a focus towards the skills and talent building in Britain.
Nodding your head, Mike.
I couldn't agree more. I think one of the most important things we should all understand is that monetary policy is a cyclical policy tool. It is not a structural policy tool, and we of course need to reorientate the economy. We need to keep employment and skills up, and that's how you raise productivity, and that is the problem at the moment. Is productivity has been incredibly weak, and that does store up problems for the future.
Mike, we just want to move away a little bit from the UK and just to ask you a little bit about the European Central Bank. You're expecting a rate cut next week. How will that impact bond markets around the European zone?
So we do think the ECB is going to cut rates, largely because the growth profile has been so much weaker, and some of the comments out of the central bank would indicate that. Whether it actually has a big impact on the bond market or not is debatable. You've got 10-year bond yield at 125, 130. If you cut the repo rate by 25 basis points, is that going to have a big impact? I don't think so. But I think what the Europeans will be aware of is the fact that the euro has become the safety valve of the major currencies, with everybody else trying to devalue either explicitly or implicitly. So I think part of the rationale, even though they probably wouldn't admit it, is to prevent the euro from going up, actually, necessarily, rather than going down.
It's hard to argue it any other way, really, given the fact that the ECB has spent so long banging on about the fact that policy doesn't get transmitted to the periphery anyway. A rate cut's only going to benefit Germany. I think
that's probably right. Yeah, I mean, I think the transmission mechanism is broken there just as it is here, and that relates to the weakness of the banking system, the lack of capital in the banking system, and a reluctance on the part of banks even to buy sovereign bonds in some of the periphery. So the ECB, we think, has somewhat addressed the peripheral risk. You see 2-year Italian yields at 10-year lows, 15-year lows. So that at least has been stopped for the time being. But loans to the private sector have yet to respond in any way, shape or form.
Mike, very quickly, yesterday you actually announced that you were reducing your risk and actually cutting exposure to Spanish and Italian bond yields. Are you buying inflation-linked German and French bonds to make up for it?
No, a lot of the time we're just putting that money on the sidelines awaiting an alternative investment opportunity.
All right, Mike, thanks so much. Michael Amy there from Pimco.